Hello, everyone, and welcome to The Buck Stops Here. I'm Catherine Murray. Well, as we know, we've seen a lot of damage in the equity markets and certainly risk assets in general. A lot of concern as it relates to the economy and the outlook for the economy. So I wanted to bring you once again a veteran, a Wall Street veteran. Barry Knapp is joining us. He is the managing partner of Ironsides Macro. Barry, great to be able to get your views and to share them with our viewers today. So thanks so much for joining us. A lot to discuss. There's no doubt about that.
Absolutely.
So Barry, let's start with, and I'm doing this a lot on the program these days, but I think it's the key driver has been for the equity markets for the past decade and continues to be. Unfortunately, it's in the opposite direction of what we've been experiencing, down. But it's the U.S. Federal Reserve. I mean, everything seems to really be reliant on what the Fed does or does not do. So what have you been talking to your institutional clients about as it relates to the U.S. Federal Reserve and what happens from here?
We have unprecedented levels of correlation across asset classes and within asset classes, which just I mentioned to underscore that point of how integral the Fed is to, what your returns are going to look like. If you start your day by looking at the dollar, a stronger dollar implies higher bond yields, lower stock prices, lower commodities, and vice versa. We've been distracted by some of the things going on in the rest of the world, but those items all can be traced back to the Federal Reserve. So, for example, after the last Fed meeting, when I thought they were going to have trouble exceeding hawkish expectations, and they were capable, they actually did that, right? The dot plot reintroduction of forward guidance, if you will, and then Chair Powell embracing that dot plot and the idea they were going to go 75 in November, 50 in December, and another 25 in January, led to chaos in exchange rate markets. The next morning, the first thing I saw was that the Japanese had intervened to the tune of $21 billion. Shortly thereafter, there was a flash crash in pound sterling. That's all been attributed to the trust government plans, but those plans were well known. And those were actually probably pretty good ideas, particularly for someone that started out in economics when supply side economics was having a real impact on capital investment back in the Reagan days. But that notwithstanding, this really has all been about the Fed. So the idea is here, we've been looking not for the so-called Fed pivot, but the inflection point when they start to slow the pace. And the analog for this is 1994. After that 75 basis point rate hike in November of 1994, we were past the point of maximum hawkishness, and the markets found relief after that. Bonds rallied, stocks rallied, and that really was the important inflection point. And so we think we're pretty close to that. We think next week, Chair Powell is likely to give a much more balanced description of the outlook, because for two reasons, really. One is because they have created global financial instability, and they recognize that. We had a couple of Lael Brainerd speeches to that effect. And then they're also increasingly concerned about the impact on the housing market and the lagged effect of policy. And we've heard that from Charlie Evans of Chicago, Mary Daly of San Francisco, and John Williams of New York. So Esther George is concerned for different reasons, but we think we have what I've been calling a developing dovish dissenters. And so that'll be really the key on Wednesday, is whether they do step down that rhetoric.
That is so interesting because, the market has just been so volatile. I don't know that mind you, it's rallying. So maybe it is actually picking up on that exact point.
I think that's right. I think we're also going through a broader transition within the markets from the pandemic rebalancing. You could see that in the GDP numbers today, and starting to move into what the trends are likely to be in the next cycle. One of the things I think you and I have talked about in the past is this idea that the benefits of the build out of the cloud, of digitization, are going to move from the producers of that technology to the consumers of that technology. And that's been on offer this week. Microsoft's weaker than expected results in the cloud. We'll see what AWS looks like tonight with the Amazon results. But the struggles of big tech relative to the old economy stuff. Jeff Curry at Goldman Sachs calls it the revenge of the old economy. And I think
I saw
that's
that.
not a bad way to think about it.
Barry, there's a lot to pick up on with respect to the Fed, but I want to actually pick up on something you just mentioned, because you and I did talk about this a long time ago. So you've had a really interesting call as it relates to big tech. Can you just explain a little bit further in terms of what you mean by this shift, almost from the companies to the consumer as it relates to tech? Because, a lot of people are seeing their stocks down. Well, I mean, Facebook's down, 28% or 20% this morning. But like, what do you mean, and how should we be playing technology?
Sure. Here's a good analog for thinking about what's likely to unfold in tech in the 2020s. During the 1990s, there was a build out of the internet infrastructure. By the time the tech bubble burst, we had 25% capacity utilization in fiber optics cables. And so there were bankruptcies that resulted as a consequence of that: WorldCom, Global Crossing, but all that technology infrastructure that was built up then began to accrue to users of that technology. The whole streaming business developed as a consequence of all that capacity and sending bits around the internet. Well, if you think about what happened in the 2010s, we took storage from each company being responsible for it to the build out of the cloud and the internet. The growth rates were fantastic. But now you've started to see companies that actually use that technology start to benefit from it. I've cited Starbucks in the past, where they built out their app and get a third of their customers to buy their coffee and skip the line. But I think you're going to see that increasingly in healthcare, in the industrial sector, as we restructure supply chains and we build out the Internet of Things, where you connect all the heavy industry manufacturing machines together. In the financial sector. And so that will drive productivity growth. That diffusion of technology or technology innovation adoption, I think, is going to be very good news for the broad economy. But for the companies that actually produce the tech, they've spent so much money, invested so much in it, and the growth rates are starting to slow. And so I think we've just evolved from the benefits accruing to the producers of that technology, that infrastructure, to the actual users of that technology. And I think we're seeing that to some extent in earnings season this quarter.
Yeah, it certainly seems to be, some big misses with the large tech companies. And thank you for that explanation. With respect to the U.S. Federal Reserve, so it sounds as though, going back to the U.S. Federal Reserve, of course, if we're going to maybe get a bit of a dovish tilt, how do you think that plays with the Biden administration as an example? Because it seems as though the way they believe they're going to combat inflation is by having the U.S. Federal Reserve continue to raise rates. So how do you square that?
That all changes on November 9th. And I'm not being flippant on that, really. If you think about a Democrat on the campaign trail asked about the cost of living, asked about inflation, when they say we support the Federal Reserve, we support the Federal Reserve's independence, in a way, they're implicitly saying we didn't do that. Our 1.9 fiscal spending, Lollapalooza had nothing to do with inflation. It was all the Fed. So the Fed caused the problem, the Fed solved the problem. As soon as the election is over, that narrative changes. In fact, it's already started to change. We've been hearing from Elizabeth Warren for some time. We heard from Sherrod Brown, the head of the Senate Banking Committee, the other day. John Hickenlooper, a governor from my state, Colorado, was on the Bloomberg headlines earlier today talking about it. And the reason is I can see the Republican bumper sticker in 2024 right now. First, you caused inflation, and then you tried to solve it with a recession. So
right.
I think it's important for people to remember that it took 10 years of inflation to create the political environment that made the Volcker Fed possible. We've had 1 year. So, when you have excessive debt at the government level, first order or way to try and resolve that is raise taxes. Well, they tried that through the Inflation Reduction Act with some tax increases on the corporate sector. it's very likely, based on betting markets and polls, that Democrats will lose the House and probably the Senate now too, which means the tax option is off the table. That leaves inflation. And so the pressure on the Fed is going to shift from tightened policy to try and solve inflation to resolve or help our election efforts to, if you drive us in recession now, then we lose the White House as well. Sorry
but
to be so blunt
they're very
about all that.
Well, no, I appreciate it, but it seems as though, in looking at Volcker and Fed Chair Jerome Powell seems to revere him, that is exactly what they're trying to do. They are trying to cause a recession. Maybe they've gone too far. We're going to take a quick break. We'll pick it up right after the break. So, Barry, I just want to pick it up on that point with respect to, inducing a recession. Have they gone too far? What does the U.S. economy really look like right now when you look at housing, when you look at labor? You get so many different reads. Even the GDP print this morning was better than expected. What's the right read?
So I've been maintaining for over a year that the neutral funds rate, or rate that's that effective speed limit for the U.S. economy, was much higher than it was last business cycle. We got to 2.5% in late 2018. The economy appeared to stall. Now, I've argued that the reason the housing market stalled then was because of the change in the tax law as it pertained to the standard deduction and the SALT deduction, which is the high property taxes that existed in my old state, New Jersey and New York, so on and so forth. And also, the trade war was causing downward pressure on growth. So I've maintained that the U.S. economy can withstand a higher funds rate, 4.5%, let's say. But the Fed's trying to do this too quickly, and they're causing financial instability, as we discussed a little bit earlier. So they do need to slow the pace. I think the path for inflation from 8 to 4 is very clear. And in fact, we may even overshoot that by my forecast by mid-year next year. But then inflation is going to stall out around that level, and the Fed may very well find themselves tightening again in the second half of next year, though clearly not as aggressively. Where we stand, though, with growth is when you look at consumer spending, which exceeded expectations a little bit today. We've been going through this giant rebalancing through the course of this year. We've had 3 quarters in a row where goods consumption was negative, but services consumption was stronger. That's the removal of COVID-related restrictions. Capital investment is a very interesting contrast from the last time we had inflationary recessions, 1970, 73, 75, 80, and 81, 82, because through the 60s, we had a real capital spending boom, and a capital spending boom in physical plant and equipment. That was increasing better than 10% per year. In the last decade, that increased 2% per year. So what we've seen in capital investment, we saw it this morning. We've seen it in bottoms-up S&P capital investment. It's much stronger because of this secular trend and need to restructure supply chains. So that creates less vulnerability than we had even in those inflationary recessions. And one important thing for investors in particular for those inflationary recessions is that earnings don't fall nearly as much as they do when credit cracks, because those recessions were characterized by falling real growth, but rising nominal growth. Earnings, even in the 2 deep ones, 73, 75, and 81, 82, only fell by 13% or so. So I would argue that earnings downside is much smaller than most of the street strategists and economists expect, because we're unlikely to have negative nominal growth. And furthermore, as I just explained, we don't have that downside risk to capital investment that could cause earnings to collapse as well, because we never had a boom, unlike the 60s.
Right. What's interesting as well, though, when you say credit's not cracking, or you don't expect it to crack, our viewers should understand as well. I mean, your background at Lehman and in derivatives. I want to get your take in terms of, do you see any vulnerabilities there? It doesn't sound like it.
So I spent a fair bit of time on this on one of my recent trips to New York, thinking about all of the private equity related debt that was raised in 20 and 21, the big growth in the leveraged loan market, high yield market. that maturity wall for that doesn't begin until 2024. And then it gets really large in 2025. So there's going to be a lot of malinvestment, if you will, real estate deals that got funded at just ridiculous levels that will have to roll in 24 and 25. And they're going to prove to be really bad deals. But it doesn't look like it's a systemic risk like the housing market was for us in 06, 07, 08. It'll be a problem for anybody who invested in that stuff. And a lot of pension plans will probably have some serious struggles, but it just doesn't look systemic like when commercial real estate cracked in 1990 or the tech sector cracked in 2000 or resi real estate in 2008.
So it sounds as though maybe we've got a little bit of a setup for better markets ahead, Barry, like maybe given the fact that we've seen so much damage that's already been done. We're going to take a quick break and then we'll be right back to get your answer on that. Thank you. So, Barry, I want to pick it up in terms of kind of where we stand now and looking at, we know that the markets are forward pricing mechanisms. Do we have better days ahead in 2023 if we've got a little bit more of a dovish tilt that you're expecting from the U.S. Federal Reserve? Will that actually help risk assets?
It absolutely should. I mentioned earlier that I saw a very clear path for inflation from 8 to 4. And I should defend that a little bit. If you think about the four major components of it, core goods prices, food, energy, and then core services prices, core goods prices have already fallen from 12.5% down to 6 and change. Energy prices have peaked, though I don't hold out a lot of hope that they're going to be anything like they were last cycle. Food prices have peaked. And within services, we've seen house prices come off considerably. Rents are coming down. Wages have softened. We've had about a 1% decline in the non-supervisory average hourly earnings rate from March through September. So the pressure on inflation is to the downside. And while we're riding that curve down, and by the way, the comparables from a year ago were quite strong in the fourth quarter, first quarter, and then second quarter. So those comparables will make the year-on-year rates of inflation come down a lot. As we're riding from 8 to 4 and the Fed is likely on hold, that'll be a good period for risk assets for sure. The back half of next year, when we reach what I think is going to be a significantly higher floor on inflation than was the case in the 2000s or 2010s, is a story for another day. But that could be a more difficult period for markets. But that first half of the year, end of this year, first half of next year should be good. It really hasn't been about the inflation outlook because we've seen market measures of inflation coming down hard. It's been about the Fed's reaction function to that, some of which is political, as we discussed earlier.
Mm-hmm. So what do you think is the best strategy? How do you want to be positioned right now?
Well, for sure, as you know, when we gave this big picture outlook for the technology sector and for the beneficiaries of that, and my outlook that this is going to be a higher or more inflationary environment than we've been through for the last couple of decades as we were going through globalization, as we move into deglobalization, that does bring us to the old economy, right? So financials and industrials, energy, materials, all those sectors the outlook looks particularly rosy for me. And that's how I would want to be positioned through this. I'm still not, although real interest rates are in a better spot than they were, they're still not, I wouldn't describe bonds as undervalued. I think this is going to be a difficult period for them, although a lot of spreads have moved way out. So high yield looks really stretched. Mortgage-backed securities look really stretched. So there's things you can do in high yield now that didn't make any sense for the last 10 years or so as central banks step back and start to let the market decide where those rates should be, not just where the central banks think they should be.
Right. Let the market mechanisms actually work. But that's a whole nother show.
It's a novel
But
concept.
real, it's what? A novel idea. Yeah, exactly. Real quick though here, Barry, what's your view on Canada right now?
Well, you've got two issues, contrasting issues. And I think that Canadian Central Bank or Bank of Canada deciding to step down was the right thing to do because of your vulnerability in the housing market. Your level of household debt to disposable income is much higher than ours. Australia has a very similar setup. And so you have a lot of vulnerability there. But then, you have a lot of energy and a lot of metals and materials. So I think not getting carried away with trying to solve a problem that wasn't so much created by fiscal policy in Canada the way it was in the US, and letting the economy rebalance is the right thing to do, not solving the inflation problem through monetary policy. That's the biggest part of the issue we have here, is that much of the inflation is fiscally driven, and without a credible fiscal outlook, which we don't have and are unlikely to have even with a change in Congress, it'll be more credible, but not credible. Having the central bank solve the whole problem is a mistake. The costs are too high.
Mm-hmm. Right. And we've seen it and benefited on the way up, but certainly on the way, or some people have, certainly not the seniors. But we're certainly seeing it on the way down. Barry, great to be with you. Thank you so much.
Thank you.